Now, what does this mean? If you look at asset allocation, this diagram shows the schematic cycle. And on the left-hand side, we look at different phases of the liquidity cycle, which we generically call calm, speculation, turbulence, rebound. Risk on is an upswing and risk off is a downswing. And then on the right-hand side, you can see what that means for asset allocation in the same phases of the cycle. So equities do really well on the way up through the risk on phase. Cash or defensive assets are what you really want in the risk off downswing. Bonds excel at the trough, that's long duration government bonds, and commodity markets do really well at the peak. And commodities are racing ahead now. Looking at world markets, commodity prices are clearly lifting significantly. And that is really evidence of the fact that we're somewhat near the peak of the liquidity cycle. So everything kind of lines up, and that's what we intend to do when we study markets. We look for consistency and to try and pinpoint where we are in the cycle. And this suggests to us that the peak is close. Now, what are the problems if you get near a peak, and what are the risks of a market sell-off? For that, we need to go to this schematic diagram, which is describing the world financial system. Now, what this diagram principally says is that at the heart of global financial markets is a debt liquidity nexus. Now, this is not the typical understanding of textbook finance because they tend to ignore this model. Their view is that capital markets are all about raising new capital for investment projects. Unfortunately, that's a very archaic or out-of-date view. Financial markets today are all about refinancing debt. And if you look at the right-hand side text, it says something like 70 to 80% of all transactions in markets, primary transactions, are refinancing or debt refinancing transactions on our estimates. So at the heart of the system is this liquidity debt nexus. The paradox is that debt needs liquidity for refinancing, and liquidity needs debt or good quality debt for collateral backing. And on the left-hand side, you see the collateral markets, the repo collateral markets, and something like 77%, very precise figure, but that comes from the World Bank, of all global lending now is collateral backed. And that's something which has moved up substantially as a proportion since the global financial crisis. Now, in order to monitor the health of the repo and the collateral markets, two things are very important. One is the volatility of collateral, in other words, the volatility of US Treasury bonds, which are mainly used as collateral. So volatility, move index, monitor that. And the other is SOFR spreads, which is the rates in the interest rates in the repo markets, which are really reflecting whether you get a collateral or liquidity imbalance. Now, what we can see on this chart here is the ratio between debt and liquidity. And you'll see the history going back to 1980 annually, which is showing the debt to liquidity ratio. What I've done is annotated on the graph where you get financial crises. I would argue that every financial crisis in the past 50 years has really been a debt refinancing crisis. And that occurs when you get high debt liquidity ratios. There's far too much debt for the pool of liquidity to refinance. And when you get that imbalance, you get a refinancing crisis, and the central banks have to come back in. If you look at the lower part of the chart, what it says there is that if you get excessive liquidity, then you get a situation where you get asset bubbles, because asset markets are the vent for excess liquidity, and you get a housing bubble, a Japan bubble, a Y2K bubble, or what we've just been through, which is the everything bubble. Now, the everything bubble was unique for two reasons. One is that when you got a crisis, be it the GFC, be it COVID, policymakers threw liquidity at the system. So there's lots of cash coming in. And secondly, they made the error of slashing interest rates to 0%. Now, when I used to work at Salomon Brothers, the US investment bank, many years ago, the key text that we were schooled on was a book called The History of Interest Rates by Sidney Homer, who was an earlier head of research at Salomon. And that book catalogued 4,000 years of interest rate history. nowhere in those pages do you ever read about zero interest rates. So the situation that we've come through in the last 15 years have been absolutely unique in human history. And that just underscores what an anomaly we've had. During that period of zero interest rates, debt was termed out. In other words, borrowers who were sitting on large interest rate loans that were upcoming in the next 2 or 3 years decided they'd refinance them, and they'd push that refinancing back into the latter part of this decade, the 2020s. And if you look at the graph, you'll see that the orange line is starting to shoot up, and it tests that broken line threshold sometime in 2026, 27. And that is basically saying that we're moving into a much tighter liquidity framework because more debt has to be refinanced. This chart illustrates that change in the annual debt roll on our estimates. The bite out of the chart in 21, 22, 23 was the response to zero interest rates when debt was termed out to the back end of the decade. The darker red bars are showing our estimates of the amount of debt that's coming back. And this is not the level, this is the change in the level. So these are increments of extra debt that has to be refinanced. If you get a problem in the repo markets, you'll start to see repo spreads blowing out. And this is the repo spread against Fed funds. Now, if this is a barometer, or even if you like a sort of a heart monitor of the system, you'll see that we're starting to get some pretty scary readings coming up. And the point to note is not necessarily the spikes, the scale of them, but the frequency. Because what this is saying is you've got increasing tensions. Now, we understand fully that repo markets tighten at the end of each quarter and they need liquidity.